Hi, this is Heather Foster with Foster Financial. We wanted to do a video because we know there's a lot of volatility in the market, which is causing a lot of questions with people on what are you doing. So I kind of wanted to do a video. I'll have Caleb and John both speaking in this video on some things to think about for 2025, ways to use opportunities of a market decline to your advantage. But I'm going to speak on what has already been done. So again, a lot of people get reactionary when we have markets that are getting volatile, potential trade wars if we're not already in one at this point, talk of recessions, talk of interest rate fluctuations, that kind of thing. So back in 2024, in July specifically, and then again in the fall, we made some strategic moves ahead of the new election. The reason why we made the moves ahead of the election is because there's a few areas or different components of the marketplace that can go up or down pretty dramatically depending on which one got put into office, because we do know some of the policies that we typically see under a Republican or Democratic party. I've used oil as a good example for most people to say, hey, do you want to own oil under a Democratic party or a Republican party? And oftentimes we get the wrong answer. They go, oh, I want to own it under a Republican party because they're going to drill. And in reality, in that example, you probably don't want to own it under the Republican Party because they're going to drill, they're going to create a surplus of oil, and that surplus of oil would typically push the oil prices down, which means it's cheaper for you to get gas, everyone's happy at the pump, but the actual stockholders of an oil company would have seen a decline in their stock value. So some things that are seemingly black and white aren't actually black and white when it comes to the market. And it's kind of the same way right now. With those moves that we made back in 2024. Those were proactive moves because, again, we don't want to be reactionary. We want to be proactive. Proactive moves that understood that if Republican Party got put into office, we'd probably see oil prices decline. If our Democratic Party stayed in office, we'd probably see them stay stable. So we don't want to own anything that's going to go up or down dramatically under one party or the other. And then the other thing is we were signaling that we may see, if it went into Republican hands, which it did, that we would see potentially a House and Senate also controlled by the majority party. And so part of that, anytime we have a year where there could be a majority party in control of the House, Senate, and the president, it leads to potential additional volatility. And that doesn't matter whether it would have been a sweeping House, Senate of a Democratic Party or a Republican Party. The point is anytime one party's in control of everything, then you will typically see a lot of legislation changes get pushed through. Those legislation changes will definitely have an effect on our markets and create volatility. So we were looking at potential volatility coming into play. And so some of the moves that we made, and I'm just going to kind of lightly go over in a grand perspective of some of the moves that were already made back in 2024 in anticipation that 2025 could be a volatile year, which obviously we are seeing it is currently a volatile year. So a couple of those moves that were made. The first thing that we did was we looked at our growth portfolio, and while we're very happy, and we were very happy in 2024 with the market returns that we were seeing on the S&P and the NASDAQ, everything kept going up and up and up. There's a point where you say, okay, this has gone up a lot. Maybe we want to remove some of the risk off the table, but we still want to be exposed in case the markets continue to go up. Buffered funds was our solution to that. So in July, roughly, we added into our growth portfolio about 40% buffered funds. Those buffered funds will still watch the S&P and the NASDAQ, but they do it in a limited fashion. There's a limitation on the downside or a buffering on the downside, and then there's a cap on the upside. So it can still give us exposure to if the markets had continued to go up, but it limits some of our downside protection. It's not that you won't still see some volatility, but there's a buffer that's built into place on those funds. So that was kind of the first step. The next step was we like to invest into things, especially if we're expecting volatility, that isn't market correlated. So just because we think there's going to be volatility doesn't mean we can just go to the sidelines with cash. We still need your money to make money, earn interest and dividends, and get paid for your money to be sitting out there. So one of the moves was to add gold, and it was to add alternatives. So we added more metals into your guys' portfolio. And we also added alternatives if you have signed that disclosure that allowed us to do the alternative investing. The alternative investing, most of you got a thing on the interval funds, but that's what that was for. It was to be able to add a sleeve of alternative investments that were not market correlated, because again, we don't want everything swinging up and down when we have volatility. We want some things that are kind of more stable during those volatile times in different market cycles that we experience. So again, the buffered funds was a pretty big move that we made. We added gold, we added metals, and then we added alternatives into the portfolio even ahead of the election back in 2024. The next thing that we did, and this was more in the fall of 2024, is we kept saying, okay, again, these markets just keep going up, so we better harvest. Harvesting is where we went into your portfolios and we either created a capital gain by selling some of the stock shares because they'd gone up so much in price value, or maybe we just rebalanced your account. Rebalancing is where when you have a market year where the markets continue to go up, your conservative investments kind of stay in a slice that they stayed the same. But your growth side, your stock side, became a larger and larger value in your portfolio. It became a bigger piece of your pie. So what we go in and do is we slice a piece of the pie off and we say, thank you for this growth, but we're going to add this back into the conservative bucket because we're happy with what we've earned. We're going to put that in our back pocket now. And honestly, maybe wait for a market decline to buy back in with some of that money. So those things, the market rebalancing, multiple times last year in 2024, we harvested and we harvested again and we harvested again. And then we kind of set your portfolios up to be less exposed to the marketplace. The other big thing, and John and Caleb will talk about some of this coming up here in just a little bit, is every one of our clients has a financial plan, and those financial plans are critical. If you know somebody that doesn't have a financial plan, they may actually be and should be concerned with the kind of market volatility that we may have in 2025. The people who lost in 2008, and the word loss is something where people go, I'm losing money. Well, you lose when you sell. The rest of it's kind of a fluctuating number on a piece of paper. The only way you really gain is when you sell at a profit, and the only way you really lose is when you sell at a loss. So gains and losses are subjective, if you will, to people thinking, oh, I'm losing when they're looking at their statement. But if you don't sell the positions, then you've not locked in the loss. So the critical part is that everyone has enough in conservative investments, enough income being generated from their portfolios to sustain what could be a recession or a market decline. So as long as you have a financial plan with us, which I'm sure everyone that we work with does, your allocation or the way that your money is invested from the get-go is appropriate for you and your income and your needs. These are the reasons why we ask you guys questions like, do you have a car purchase you're going to need in the next 3 to 5 years? Are you remodeling your basement? Are you putting a new kitchen in? These items are critical because we've set aside money for those reasons. So that way, if we got into a market decline at some point, which we're in right now, we don't have to sell equities to fund those needs. We've already got them set aside and put into more conservative investments. Again, I know it's not fun to see your statements going down, but you've also seen almost a 24-month period where every statement was a positive, and it is part of a market cycle. Caleb's going to talk a little bit about how this isn't as unprecedented as people may think. Again, tariffs and trade wars has been going on for a long time. You can go back to 2018, 2016, and look at the policies. So it's gotten a lot of media attention, and it's definitely pricing into our stock markets right now, but it's something to not overreact about. So I'm going to let John and Caleb kind of take it from here, and then I will see you guys at the end of the video.
Hi everyone, Heather was able to talk a little bit about some of the strategies that we preemptively implemented in the portfolios in mid to late 2024, and today I'm going to talk a little bit about some of the strategies we're going to continue to use into 2025, and even some new strategies with the recent stock market drops there. The first one is just looking at interest rates, and so there were already some anticipation of interest rate drops over the course of this year with the recent fluctuations in the market. There are even more interest rate drops that are anticipated, and so now can be a really good time to lock in interest rates for a longer period of time, so you get that high interest for more years than what you would in something like a 1-year CD. Often CDs at the bank, you can lock them in for at most 1 to 2 years maybe. We can use different tools like multi-year guaranteed annuities or different things like that where we can lock in the higher interest rates for 5+ years. And so if you have CDs coming due or cash in a high yield savings account, for example, reach out to us and we can talk about some options there. Also, just wanted to talk about alternatives in the portfolios. And so alternatives are typically investments that are maybe not as correlated to the S&P 500, for example. So we sent out like an interval mutual fund disclosure form that many people signed at the beginning of this year. That's an example of some alternatives that we like to use. Gold is another example of one that we like to use. Gold has done very well over the last year. So we like to have a portion of people's accounts invested in some of those alternative positions. Another thing to mention is contributions to the investment accounts. And so if you're somebody who's a regular contributor and you're maxing out your Roth IRA over the course of the year or investing in a brokerage account every single month, it could be a good idea to accelerate the timeline of those. Maybe we max out the Roth earlier in the year because of this recent stock market drop, or maybe we increase our contributions to the investment accounts there. Or if you just have cash on the sideline and you're waiting for a stock market drop, a good buying in opportunity, give us a call and we can talk about your time horizon for that and see if it makes sense for you. Also, if you have outside investment accounts that maybe you're managing on your own and you think, hey, I kind of want to get a second opinion on this with all the recent stock market fluctuations, reach out to us and we're very happy to help with that as well. The last thing I wanted to talk about is our anticipated recovery. We still think the stock market is going to make a full recovery. The timeline on that, I think, is going to be determined by what happens with the tariffs here, whether it ends up being more of a trade war that could possibly trigger a recession or a slowdown in growth in the economy, or whether it's a little bit more transitory and that there are tariffs, that deals that will be made where then countries will all lower their tariffs across the board. So the timeline for a recovery would certainly be determined by what happens there, but we're still very optimistic about the stock market when we think long term. And we always want to be long term when we think about the stock market. These sort of fluctuations are things that we anticipate when investing in the stock market. So when we think 3, 5, 7, 10 years down the road, we think now could end up being a good buying opportunity in the stock market. And so if you ever want to talk about that, reach out to our office and we'd be happy to do that.
Hello everyone, this is John, and I wanted to take some time to discuss with each and every one of you the importance of your financial plan. And so whether it was the first time you stepped foot through our doors or the last strategy session that you had with your advisor, your financial plan was the focus of your meeting with that advisor. And it is a very, very important thing to bring up in times like this because the Foster Financial team has planned for situations like we're going through right now. And so the first thing I want to talk about is your income plan. And so for the majority of folks who are receiving income from their investments with Foster Financial, your advisor has already taken a proactive approach to set aside those income needs for anywhere from 1 to 3 years in a conservative style investment that is relatively unaltered by market downturns like the one we're seeing right now. And so in most cases, these set aside positions, whether it's for your qualified charitable distributions, your general income need from our portfolio, or maybe for a large upcoming purchase within your financial plan, those assets have already been set aside in a way where you can access those funds efficiently and unaltered by market downturns or any volatility of the case. And so that is an important piece to remind our clients about during these market cycles. When equity positions are down from their all-time highs, income needs have already been set aside within a conservative position for you. And also another proactive approach that we'll be taking here in the near future is discussing Roth conversions with you. And so a lot of you have done these before, but essentially a Roth conversion is a way to move pre-tax assets from a traditional IRA to a Roth IRA. And by doing so, it effectively frees up your tax need on those monies for the remainder of your plan. And so right now, if the markets are off their highs, it provides an opportunity for us to convert these assets early in the year rather than in November or December of the year, as many of you have grown accustomed to. And so the strategy here is that we may do a partial Roth conversion for you early in the year to try to take advantage of the downturn in the markets, and then do another Roth conversion closer to year end to fine-tune the details of your income. And so more to come on this, but you will be receiving a call if you and your advisor have spoken about Roth conversions for 2025. Another piece of the puzzle that we're putting into action right now is going to be tax loss harvesting. And so for those of you with a brokerage account or non-qualified asset, you and your advisor have likely talked about the real possibility of this occurring during a market downturn. And what this means is that we're going to go into your accounts, the brokerage accounts especially, and potentially sell some assets off their highs, whether it's a position that you've had within your account for a long, long time that has a very, very high capital gain that can now be sold at a less capital gain, or whether it's creating some losses on your accounts to offset some gain realized in the beginning of the year. These are the items that are so crucial that have already been built out within your financial plan that can be taken advantage of in times like this. Financial planning is a very, very wide array of different conversations and styles, but Foster Financial, our focus is to provide you with clear details on these financial plans and the action plans that we provide you with. So your advisor will be in touch with you with any changes soon. And if you have any questions, please don't hesitate to give us a call. Thank you.
All right, so if you guys have further questions, as John and Caleb alluded to, please just call our office. We're happy to talk to everybody. If you're getting overly concerned, or even if you just want to spot check that your financial plan is on track, or maybe you forgot to say, hey, we actually need to add something to our financial plan. Is that okay? And would I still be okay? That's kind of why we see you guys on a regular basis. And we're always asking you, and it may seem invasive when we say, hey, what do you plan on spending? But the reason we're asking those questions is because we want to make sure we've set you up for success. That we can walk you through even when the markets are going down, to not ever decide to sell everything when the markets are down, to have a financial plan that's solid, that's in your best interest. So thank you for listening today, and again, feel free to call our office. We're always here to answer any questions that you may have.